Alright, hello and welcome everyone. Today I will teach you how to quickly analyze a stock. This is a good way to determine whether the stock is overvalued, undervalued, or fair valued within a few minutes. If you like this video, please do like and subscribe, as it does help our channel and allows us to get this content out to more people so that more people can understand how to analyze stocks and learn more about specific stocks that we analyze on our channel. Anyway, thank you so much for the support, and without further ado, let's get started. What is the first step I take when researching a stock? The first part of my research is really simple. I Google the company and see if it's profitable or not. An easy indicator is if the PE is not displayed. If it's not displayed, it's probably not profitable, and therefore it has a PE that is less than 0. Or it is barely profitable, so the PE is very, very high, perhaps over 1,000. I would like to note before we go any further that if you would like to get a full stock analysis, I would then look through the 10K and compare earnings using that. The 10K is very important, and it is essentially what you can use to really determine if a company is worth investing in. The 10K even goes in depth as to what risks the company may face, and also it will segment out its earnings for you. Using macro trends, you can plot the price to earnings and compare the company to its peers, as we've done here. You want to make sure the price to earnings is below its peers or similar to its peers. Next, let's take a look at the free cash flow. In another video, we teach you how to determine the intrinsic value of a stock in a way that anyone, even new investors, can understand. I'll link it in the description below. Free cash flow is the building block of that intrinsic value, and we can determine many things from it simply by looking at it. Free cash flow is basically the cash inflows minus the cash outflows. If the company is paid for their work, not in credit, which would go under accounts receivable, but with real money, that is a cash inflow, and if employees are paid, that's a cash outflow. This should always be positive. If it isn't positive, it means the company is putting out more money than it is bringing in, which may put the investor at risk of losing their investment quickly. Be sure to invest in stable, positive free cash flow businesses. Next, we need to discuss EBITDA and net income. Net income is helpful when analyzing a stock, but net income takes into account depreciation, unlike EBITDA, which is earnings before interest, taxation, depreciation, and amortization. This can make EBITDA a more accurate measure of growth, but net income is important to determine whether the company is really making money. If the EBITDA is positive and growing, this shows the company is building and reinvesting in its growth. Net income should also reflect this, but make sure that net income is positive, otherwise the company may not be profitable, and therefore I would prefer to look at another stock to invest in. Shareholder benefits are very important as it shows whether the company really cares about offering you a return on your investment. If the company is consistently profitable, as we can determine from the net income, it would make sense that the company offer a form of dividend payment regularly, typically quarterly, and maybe even a stock buyback program could be implemented. Dividend income is crucial to retirees, which makes telecoms like Verizon and AT&T very attractive with a near 7% return from dividend payments alone. Also, make sure the dividend payout ratio is below 1 or 100%, as this would mean the company can sustain its dividends. Stock buybacks is another way a company can offer you a return on your investment. They can buy their own stock back to reduce the shares outstanding, and therefore you own more of the company. As a result, you own more assets of the company. Be mindful if a company buys back stock at a price that is not favorable, as in the price is far above a price to book that is reasonable, let's say between 2 and 4, then this could actually be costing the business more than it's benefiting you. So when analyzing a stock, look at the shares outstanding, dividends, and payout ratio. Anyway, hope this helps. I simply wanted to give you a straightforward, quick, and simple video on how to analyze a stock. This is a bare bones way to analyze a stock, so you would need to look at the political and economic factors in the industry, fully analyze competitors, compare products and services, as well as thoroughly read a company's 10K before deciding whether or not to make an investment in a stock. I will continue to make tutorial videos to help you analyze stocks. I think it is very important that we make investing simple so that everyone can learn it. Anyway, thank you so much for watching. If you liked this video and want to see more content like this, please do like and subscribe, as it does about our channel, and please comment down below and tell us what technicals you use to analyze stocks, and we'll try to get back to you. Anyway, thanks again for watching, and have a great day, everybody.